in business and finance from across the globe about our prospects in a rapidly evolving environment. What does the data tell us about what our future world might look like?
Good morning, good afternoon, and good evening. I'm Keesa Schreane, and welcome to Refinitiv Perspectives Live. Trading volumes have more than doubled during the high volatility days of March. More recently, we've seen some stabilization with below average volumes in July. But with November's U.S. elections ramping up alongside developments of the pandemic situation, how can traders in the trading community prepare for future market situations and the volatility that will surely accompany them? Also, how will these challenges shape the trader of tomorrow? Joining us to help us find some answers to these questions, we have Quentin Limouzi, head of buy-side trading at Refinitiv, and Kevin McPartland, head of market structure and technology research at Greenwich Associates. Thank you both so much for joining us.
Thanks for having me.
Yes, sir. Good morning.
So first of all, what are you both hearing from clients about the current situation? Quentin and Kevin, what's going on out there?
Well, Keesa, it's amazingly, our clients have been adapting really well to the current situation, that was brought in by the COVID crisis. I mean, when you think about it, Wall Street is probably one of the places where people think that they would never be working from home. The trading floor was the untouched marketplace and working place where everybody had to be there early, had to be heard, and had to work from there. The crisis has shown us that, moving to working from home environments, both on the buy side and sell side, have been possible and have been successful. So, what we're hearing from the clients, I would say on the buy side, they're more used to versatility. They have more trading and portfolio management tools that the sales side has to work from home. They're more used to be on the road. You have a lot of buy-side traders who double up as a PM as well, so they're on the road a lot, and they need to be able to manage their risk and trade from the road. On the sales side, as I just said, it was a completely new life, and I started talking to my old teammates and friends in Hong Kong when it started in Asia. And, they shifted rapidly from DR sites and then working from home, and then everybody worked from home. And most of the people still are. So I would say, thanks to technology, which we're going to develop on, and the ease of use of technology, the COVID crisis has not been as disruptive as it could have been. And one last point to add is this all happened at the same time as, obviously, because of the crisis, the market volatility and the volumes went through the roof, as you pointed out. So not only did people have to change their way of working, they had to do it in an environment that was far from the norm. And I think most of the clients that I talk to are, very happy that, all the systems were stable, as far as Refinitiv was concerned, and that they were able to continue doing their work the same way and sometimes better than they were before crisis.
Great. So Kevin, tell us about your buy side and sell side contacts. What are they saying?
Sure. Yeah, no, and I would echo most of what Quentin said. It really was amazing what went on, especially in the spring. I think most folks went into this thinking, okay, this will be a few weeks. Maybe it'll take us to the beginning of the summer, and then the world will start to get back to normal. We've all obviously seen now that's not the case at all. This is going to be the way things operate for the foreseeable future. Definitely, I think the industry should sort of pat itself on the back a bit that there were no major outages through that crazy time of volatility and sudden working from home that nobody ever saw coming. So that was pretty amazing. Although if we fast forward to today, I think we are through the acute stage of the market crisis, if you will. I think we're finally seeing some calm in the summer, which is not a bad thing, with volumes down a bit. The market seems to have a grip on both the state of things, the state of the economy. There's a lot of unknowns, of course, but at least people are starting to grasp what those risks are and how to manage them. And then central bank and sort of government intervention has been so strong and swift that also is helping markets to sort of stay a little calmer than they might have been otherwise. The U.S., the Federal Reserve in the U.S. Is actually not doing all that much buying these days, but they did announce this morning they would extend those programs at least through the end of the year, which I think even just knowing that they are there as that sort of buyer or lender of last resort, depending on the case, that also gives the market some calm. So it does seem that we are sort of through the acute phase and feeling as comfortable as we possibly can given this unprecedented situation.
So you bring up the points about shifts. So we've seen shifts in volumes as well as the Federal Reserve's response. One of the shifts that we've also seen, and this is more of a theme, is the shift from passive to more actively managed investing. Could you tell us why this shift has occurred and what we can expect to see in the future, Quentin?
Absolutely. I mean, the recurring theme post global financial crisis was that money was moving from actively managed to passively managed. And we've seen a constant inflow going from one to another. And really the reason for that was, we've seen a 10 plus year bull rally, and at least in the US and in most of the world in stocks. And it makes it very, very difficult to outperform the market when that happens. Research is expensive, having analysts is expensive, trading and finding the right stocks to beat the benchmark is very difficult. So that's been the last 10 plus years. What the crisis brought is volatility and price distortions, right? When there is a huge shock, as we saw in March, the S&P and most asset classes all go south one way indiscriminately, right? So the winners, the losers, everybody goes down, and that brings on the active guys who have been looking for opportunities to get in or out of stocks, and now seeing price distortions that are making the trade possible. So, for active managers, they've been able to, hopefully with success, right? I mean, nobody predicts where the market is going, but they've been able to get in and out of the markets and peaking levels. While if you were a passive tracker, well, you just had to sell when everybody was selling and buy when everybody was buying. So it's, at the end of the day, there was a lot more opportunities for active, active managers. And, as I recently pointed out in a blog I wrote, it's a trader's market, right? Again, price distortion, volatility, make it for a trader's market. So, not only do you have active PMs looking at price levels that they like and choosing sectors and choosing what they think will be a winner out of this ahead of the rest of the market, but you have traders as well acting a lot quicker based on price distortion. We've seen price moves of 10, 15, 20% in a day, even 10% in 2 days on big chip names. That is, that means a lot of opportunities for a trader to get in and out and hopefully make winning trades, while everybody else is having a longer view. An active manager and an active trader, whether they're a day trader or prop trader or very active altogether, are able to, get a lot more trades done and get a lot more opportunities done.
And Quentin, you raised a point about no one having a crystal ball, right? The passive way of doing things really can't determine the future. And I know, Kevin, you wrote an excellent piece in the first quarter of this year on the future of trading, but that was in first quarter of this year and things have changed. So in terms of how you would say things have evolved, and if you could go back and take some of those concepts and rewrite them and evolve them based on what's happening now, and even what you expect to happen, say, in 2021, what would that revision look like?
Yeah, it's a great question. And it was really, thinking back, right, we thought about the future of trading through 2019, like you said, into the first quarters. We published a few of these pieces. And of course, a global pandemic and, the entirety of the capital markets working from home was certainly not on anybody's radar or planning for the future, without question. I think, a lot of the findings, though, I think really stand. And I think a lot of the work that was done in terms of automation, artificial intelligence, better leveraging the data that we have available to us, is really what has allowed the industry to continue to move forward and to be successful. So one of the statistics in the piece from the first quarter, we said 80% of capital markets professionals told us that technology has provided them with new career opportunities. One could argue at this stage, working from home, technology is effectively providing everybody's career full stop, right? That without, even 5 years ago, we didn't have video conferencing that we have today. Even the technology that we're doing this broadcast on barely existed 5 years ago, at least not to the level of sophistication it does now. So I think this is not, of course, what Wall Street was planning for, but all of the automation, the move to more cloud-based technology that allows everybody to quickly log in from home. Think about how many thousands of traders needed to log into everything from their data terminals to whatever trading platforms they need, given the asset classes that they trade, but to do it suddenly from home, some from laptops, some from personal computers, at least in those first few weeks before they had better setups. It's amazing that it worked. And I think a few years ago it wouldn't have, without sort of the push we've seen over the last few years to get to that more sort of cloud-based, automated state that we're in today.
So, Kevin, even now, I know that a lot of folks are saying that this is not going to be the last pandemic. This is not going to be the last global situation that we see of this nature. With that being said, how do we expect the future to completely change? So just even beyond as you mentioned, the technologies that we use today, do you think that the future of the way we trade will change based on how our culture and environment and society is shifting?
Yeah, well, let's think about, if there's silver linings in such a terrible situation that we're in, there's a few things, right? So if we think about business continuity planning, especially for the largest trading institutions, whether investors or the banks, many of them have these massive sort of offsite facilities that they would move traders to in the event of a catastrophe. They use them in this case, but only very shortly until they realized people needed to not be together at all. Mm-hmm. So there's a big shift towards now the business continuity plan is send everybody home, right? Which nobody thought could work, and it can. So that actually could be, over the long run, could be a cost benefit, right? A cost savings, I should say, to the industry. I think we'll also see a continued further push of collaboration technology. There's been a big push forward of that anyway, right? The use of chat and such it's really expanded pretty dramatically anyway. But we've seen even through the big firms, the Zoom and Microsoft and the like, right, have really sort of expanded their platforms. I think we'll see some more interesting, trading focused collaboration tools that'll come to play that'll allow a feeling that is more like you're having that real-time information flow you'd have at a trading floor, even if you can't be. Now that said, I think it's important to point out trading floors will come back. There is a lot of value to that. It's been reported, right, in New York City specifically, really the first movers in terms of getting folks back into the office have been the trading desks, right, at some of the largest firms. So hopefully that will go well, right, and we will see more of that, even if at a reduced capacity. So the world has been forced to deal with a tough situation, but there, will be some long-term efficiency and cost benefits, I think, that will come out of the shift.
Trading desks are coming back. We heard that one loud and clear. Thanks for that, Kevin. We're going to open up questions from the audience shortly, so please get those questions ready. Meantime, let's talk about, again, the role of the trader in today's environment. You mentioned the technology that we have coming. Such as AI and machine learning, those specific technologies seem to really be prevalent in your report, in your findings. Do you find that this type of technology is in fact helping the traders, or do you think that there is an element in which trading is being hurt by AI and machine learning specifically? Yeah, no, I think it's a help, right? The technology, a lot of it is about augmenting traders, making them more efficient, allowing them to do more in their day, right? And that's really where AI has been focused. And really AI, and we wrote about this quite a bit, right? It really is in its early stages in financial services. If we look at some of the sort of the more immediate use cases for artificial intelligence on the trading desk specifically, a lot of it still, quite frankly, pales in comparison to the artificial intelligence behind even a Google search, right? When you Google and it starts to tell you what it thinks you're searching for. Right, that's really incredible artificial intelligence.
So bringing that level to the trading desk, right? We're still working in that direction. We're still getting traders comfortable with these ideas. But even short of that, ways that the ability to go through massive amounts of data, right? Something obviously Refinitiv does a lot of, right? Looking at these massively huge, unstructured, often data sets and making some sense out of them and helping traders to decide sort of what the action is. That's been a huge step forward, and there's a lot more of that. And yeah, and most of the traders we speak with, buy side, sell side, it doesn't matter. They're starting to really appreciate the benefits of these tools and see that it will only help them going forward. There was a lot of job cuts after the credit crisis, which now was over a decade ago. That seems to be mostly behind us, and what we have now are much more sort of tech savvy and folks that see that it's about augmenting and not replacing.
So I'm wondering, Quentin, in what you've seen, I know when people think of trading, they think of companies and departments, businesses that have access to the cash that's needed. Well, can some of these technologies be cost prohibitive? Are there budgetary restraints now that we didn't see in the past that would lead us to put a pause on AI and machine learning that can really help trading?
Well, I think of us being able to help there. I mean, if you look at the Greenwich survey and work that Kevin and the team have put together, talking about the future of trading and the future of being a trader, data scientists have a big role to play there. Who do buy side and sell side want to hire on the PM and on the trading desk right now, or in 3 to 5 years, are data scientists. They are Python developers who can be versatile and who can use that data and create new parameters and new alerts to trade from. So I would say that AI and ML, in my view, and I love the fact that Kevin used augmented intelligence rather than artificial intelligence, are really here to help humans. And a very simple fact is that we are in the big data era, and that data is just not ingestible by the human brain or eyeballs. We need machines to help us. I heard an incredible stat from our friends in the labs telling me that in 2020, we as a human existence will create more data than was ever created between the beginning of times to 2003.
Wow.
So put that in perspective. Think about what a trader does, which is looking at data all day long, and just by the sheer amount of volume that is being created out there, we need AI, we need ML to help us, make sense of that data. Where Refinitiv really plays a big part as the data company, because this is what we do for a living more than anything else, is really to make sure that data that we provide our clients is machine ready. So we scrub it, we make sure that they don't spend their time normalizing it, scrubbing it, but they have data sets that they can directly go to and test out their hypothesis, make sure that their trading strategy makes sense, rather than spending months and months and months to clean up the data on a hypothesis that may not have made sense. So the integration of data into the trading environment through automated trading tools, and all of that being available in the cloud, SaaS-based, as Kevin mentioned, has been a trend and is there to stay. 80% of the people in the industry saying that technology was helping them rather than hampering their career was a great number to see 4 months ago. As Kevin said, with the crisis, it's 100%. None of us would be able to function if we didn't have technology. Wall Street would probably be closed, right? Like a lot of other businesses have closed. So I think we need to embrace it, understand it, and make sure that from trade inception to execution, there is a link. And that's certainly what, in the buy-side trading world of trading of Refinitiv, that's what we're trying to do.
Great. Thanks, Quentin. Going back to some questions from our audience. What are the biggest challenges faced by the buy-side fixed income traders in terms of changing regulations? Kevin, could you shed some light on that for us?
Yeah, sure. Interesting. So interesting is that in fixed income markets, particularly bond markets, there's been a lot of innovation over the last 5 years, a big push for electronification, electronic trading. But interestingly, there hasn't been a huge focus from regulators on this market. I think particularly in the U.S., the SEC, one of the big overseers of fixed income markets, has had their hands full with more equity market challenges, concerns about sort of retail consumer protection issues. And so while there is a focus, there is a working group there, there haven't been any major proposals for big changes to the workings of the bond markets. Interesting, though, I think what will come over the next 6 months or so is, a look back at what did really happen in March and April. There certainly were big liquidity gaps there. Sort of early analysis, and from the market's perspective so far, right, it doesn't seem like there was a market structure failing, if you will, right? This was purely an economic problem. But we should definitely expect regulators to take a closer look at markets to understand how they worked, what went on in that acute phase, and maybe if there is anything that should be done to help alleviate that potential in the future, we could see some of that. But I think for fixed income traders at this point, right, the focus is more on sort of good old-fashioned market dynamics and making sure they have access to sort of the latest and greatest technology, which is increasingly driving activity in those markets as well.
Great. So for fixed income, market dynamics as well as the use of technology, which seems to be a theme here. One for you, Quentin, talking about the use of alternative data as people deal with COVID. Could you tell us some use cases around that?
Absolutely. I mean, alternative data is part of the big data equation that I was talking about earlier. So the more alternative data source that we can give our clients, the more number crunching can happen and correlation in many cases. Tied into alternative data and the messaging of data, I would talk about also new analytics. That's probably something that is going to come out of this crisis. Kevin just talked about this in fixed income. The same can be said about equities. I think a lot of traders or PMs or sales traders in the industry think about liquidity in terms of volume. If there is one thing to be remembered from the March crash, is that there was a lot of volume, but liquidity wasn't there, and hence you had moves that were absolutely massive. So what we're doing, I'm working with our labs on this, and we work with our clients quite a bit on this as well, is trying to make sure that we understand what happened and we provide tools for our clients to then analyze better in a post-crisis world what the real risk is, what the real impact is when trading. So, rather than looking at volume, we're working on a limit order book study right now that looks at 10 levels up and down of the order book real time, and will tell us what the density looks like, what the aggressiveness looks like, and we'll tell a story and signal our clients if now is a good time to implement a trade, or if the market will actually move tremendously if that trade is placed at this time. It goes way beyond just looking at volume.
Great. So we'll end with one final question. We've talked a lot about risks that traders need to look for. We've talked about the volume shifts, and we've also talked about technology and how that's played a huge part and will continue to play an even greater part. If we had to talk to traders in the trading community regionally, if we look at the Americas, APAC, EMEA, would we have different advice or a different thought about the direction that they should move into based on the region? Kevin, Quentin, what do you say?
Yeah, I mean, it's a really interesting question. I think a lot of these themes are global. Sadly, right, the current crisis that we're in is very much global, which is another way that it is unique from, previous market shocks over the last 20 or so years. But, the move towards electronic trading, in fixed income, for instance, we see that in every region, right? It looks a little different in each case, given local market dynamics, but it is certainly happening. The importance of, again, automation, the cloud, all of it is happening globally. So, certainly there are, local regulatory issues, again, market dynamics, who the participants are. The U.S. market is one big market. Obviously, the EU and Asia are many, many markets sort of that come together, often, again, with their own local regulations. So, of course, that will always be the case. But from a tech perspective, these trends do really seem to hold globally.
Right. And Quentin, we heard a lot about, as you said, EMEA, the Americas. If we look at Middle East and Africa as well, would you have any advice or thoughts about differences in regulation or other differences in terms of globally how they'll be moving forward from a trading perspective?
I mean, really, as Kevin was saying, this was global, and when we talk to our clients, we get the same feedback everywhere, and that hones in, on having access to trading and portfolio management from home. So, the ABCs of lesson learned in this crisis is, make sure that your provider is a SaaS provider and you can trade and view your positions and manage your risk from home, not remote access into an enterprise system that sits in a bank. New analytics is something that we're being asked for, and access to more data. Old data and regular data is something that we see as a thing globally, and multi-asset capabilities as well. Whether it's trading, whether it's viewing, pre-trade, because so many of these asset classes are correlated during the crisis. It beneficiates everybody to look at another asset class. It beneficiates even more to being able to trade that asset class as a primary asset rather than just a hedge if your mandate allows you to do so. And that's why I think active managers have the upper hand there.
Mm. So access to data, technology, as well as a good, solid business continuity plan definitely plays a role in all this in terms of the present and the future of the trading community. Kevin, Quentin, thank you both for joining us.
Thanks so much, Ryan.
Thank you very much, Keesa.
And thank you for our audience for joining us. For more information on Refinitiv's trading and equity analysis and to reach out, scan the QR code or type the URL. It should be shown on your screen now. I'm Keesa Schreane. Thank you for joining and be well.